Welcome back to Fundamentals, the investment fund podcast, where we discuss the complexities of different fund structures, regulations, and considerations in Malta and beyond. I'm joined today by my fellow auditor, Borg, Olivier, and we're thrilled to also welcome a special guest with us today, Filip Suchta, to go into one of the most essential pillars of investor protection, being the custodian. For those who tuned into our last podcast, you may know Alan. He's an audit leader here at Zampa Partners, and he manages a good number of our fund audits. Filip, from your end, if you could give us a brief introduction about yourself.
Sure, absolutely. My name is Filip Suchta. I'm a branch director at Q Securities. We are an investment firm with headquarters in Poland and offices in Luxembourg and Malta, which I have the pleasure to head. We're mainly an investment fund depository, specializing in alternative investment funds, and we service over 250 funds in all these three jurisdictions with overall assets exceeding 20 billion euros.
Wow. Okay, so that's quite a bit there. So thank you for that, Filip. In episode 1 of our first podcast, we had explored the different fund typologies where we discussed UCITS, AIFs, NAIFs, PIFs and MPIFs, so the different type of fund structures that you would typically find here in Malta, and also the unique characteristics, including audit considerations for each of those different fund structures. Today, we're shifting our focus to the infrastructure that keeps investors' assets safeguarded, and that is where we talk about the custodian. So let's start from basics. Filip, if I could start from you. When we talk about a custodian, what do we mean? And how would this work within a fund structure?
Sure, absolutely. So basically what I would say is that the term custodian, as it's commonly used in Malta, it's basically a safekeeper and watchdog of the fund. So on one hand, we take care of the security of assets. On the other hand, we act as an overseer of the fund's operations. In a sense, you could think of us as a live auditor.
Okay.
So maybe not doubling your function. We're focused, of course, more rather than on financials, on the fund's operations.
Yes.
We ensure that all the fund's operations are done in compliance with applicable laws, the fund's documents, and of course, in the end, we protect the investor's interest. So yeah, exactly. So sometimes when we have discussions with clients, especially fund managers, which tend to be the ones that employ us, they ask, "What do we need you for?" Because basically, sometimes with a wrong depository, having a depository or a custodian can be a hassle.
Yes.
But we tell them that you pay us to protect your investors, to make the whole infrastructure of the fund safer.
Yes, that's it. And we'll go into the requirements then later as well. So essentially, the custodians are responsible for holding and safeguarding the assets of a fund, whether we're talking about financial instruments such as equities, bonds, or cash accounts linked to the fund. So based on this, Filip, we do talk about custodians, but we also talk about depositories. How does the role of each one differ?
Sure. So as I said, the term is currently commonly used in Malta is the custodian.
Yeah.
But in fact, the custodian role is limited to safekeeping only.
Okay.
So historically, custodians were appointed to make sure that the assets of the funds were safe. And that was all they did.
Yeah.
And ever since, actually it was in the UCITS directive, but it was really ironed out, the details were ironed out in the AFMD, so 2011. They added more responsibilities onto the depository, the watchdog function or the oversight function that I mentioned. So right now, the depository is the actual correct term you want to use.
Okay.
If we're talking about a fund setup system. And the depository, aside from keeping the assets safe, and that of course differs from what assets are we talking about? We'll get to that later. But aside from the safekeeping part, you have the cash flow monitoring, and then you have the oversight duties. And the oversight duties basically concern all the fund's operations, transactions, investment limits, subscriptions, redemptions, paying out dividends. This is something that we look at on a constant basis to make sure that it's in line with all the applicable laws and regulations. So this is what I mean when I'm talking about a depository versus custodian.
Yes.
Here it's used interchangeably, and funnily enough, only recently the MFSA has updated their rule book for the depository, and hopefully now everybody will be talking about the depository in line with the European regulations. Yes. Although I assume that still, when we'll be talking about our role, I will face clients that will speak about a custodian rather than a depository.
True. So I think you mentioned the oversight as well. It's a very broad term, but there is a lot that would go into that.
Absolutely,
So
And a lot of responsibility as well.
yes, that's
True.
it, to ensure that those are kept safe, the assets. Alan, I'm going to turn to you. Factoring in what has just been said, talking about the difference between the two and the responsibilities. When it comes to auditing a fund, and considering the custodian or the depository there that's been appointed by the fund, how would you assess the reliability of that custodian, given you are relying on documents that the custodian is providing?
So, I mean, as we've been discussing, clearly the custodian, the depository, has a lot of responsibility and plays a very important part within the setup of a fund. I mean, now from an audit point of view, speaking in terms of auditing standards, I mean, a custodian would be deemed to be a service organization. So us as auditors, we are required to understand who the service organizations are within the fund. So not only the custodian, but even the investment manager, fund administrator, and all the responsible parties. And basically what we need to do is understand the controls that the custodian, the service organization, would have in place. Now, how do we understand the controls? It can be done in various ways, either through meetings with management and discussions, through review of an ISAE 3402 report, the service organization report, if it's available, because it's not, it might, the service organization may not opt for this report, and also through review of internal documents and policies and procedures.
And that report, the ISAE 3402, does give quite a bit of comfort from a controls perspective.
Yes, basically what it's summarizing in 2 seconds is all the controls in place that the company has and whether these controls are operating effectively.
Does a bit of your job for you.
Yes, that's it.
Yes.
But we still need to review it.
Of course.
No, we need to review it and we need to understand whether we can place reliance on it or not.
Yes.
Because obviously if we're placing reliance, then it has its risks as well.
Yes.
And now in terms of controls, the typical controls that would mainly be looking at are asset safekeeping and safeguarding, trade settlement, cash custody and payment, corporate actions, income processing, record keeping, and also compliance. As Filip mentioned, they play an important role in the compliance aspect as well of the fund. So we've spoken a bit about the service organization. Now, when it comes to actual financial information, what are we actually using from the custodian? And at least in my opinion, the most important piece of information that is being obtained throughout the audit is the year-end custodian report.
Yes, exactly.
Which ideally we are obtaining directly from the custodian, so it's sort of an independent report that is being obtained rather than getting it directly from management of the fund. And here basically we're mainly verifying and ensuring that ownership of the investments is in the name of the CCAV.
Yes, that's it.
Now you could also perhaps use it for valuation, but over there you need to understand the controls in place by the custodian with respect to valuing the investments, mainly for listed equities or listed investments. I mean, if they're using reputable sources and you can see that the controls are operating effectively, then over there, yes, you possibly may place reliance on the custodian report for valuation as well. But definitely for ownership, it's a must that you have this report in hand.
In fact, this is something that we obtain from the client usually directly. But in the audit world, that third-party evidence is always the most reliable evidence that we obtain. So apart from obtaining, for example, our standard bank confirmation that we always circulate at the beginning of our audits, we also obtain the investment the confirmation of investments from the custodian or depository in that case. So yes, essentially it is something that we rely heavily on to obtain and to be able to, as you mentioned, verify those assertions that we typically use in audit, being in this case ownership and valuation where possible as well. And again, what we're basically saying is we need to be understanding the work of the service organization, the controls of the service organization, what they do, and we need to ensure that we can rely on them if we want to be using that information for our audit.
For sure, if we're going to be using placing any reliance on the service organization, then we must obviously understand and ensure that the controls that they have in place are operating effectively.
Yes,
otherwise you cannot be placing reliance and obviously have to shift your focus sort of to fully substantive testing approach.
Yes, that's it. Filip, if I can turn to you again, if we could give our viewers just a bit of context. We talk a lot about the safekeeping of assets when speaking of custodians and depositories, but what exactly do we mean by safekeeping of assets?
That's an excellent question because it really differs from the nature of assets that we're talking about. So both the AFMD and the UCITS directives and throughout that local laws and guidance from local regulators differentiate between two types of assets primarily. So one are the custodiable assets or assets to be held in custody, and these are primarily financial instruments that are capable of being recorded on a financial instruments account. These assets need to be held in custody with the depository, and of course, then within that function, we're talking strictly speaking about a custodian role.
Yes.
That's the only part, really, if we're being honest. And these assets not only need to be kept in custody, but they're also related to a very strict liability regime. So if anything happens, the overall idea of keeping the assets in custody with your depository means that the assets are segregated from the fund manager, and from the depository as well. So if anything happens to them and there's insolvency anywhere in the custody chain, the depository bears full liability for loss of these financial instruments. There are also physical financial instruments, and here it's important to differentiate between physical assets and physical financial instruments. Physical financial instruments are also to be kept in custody. Of course, in 2026, we find
gold and
no, that's exactly what I mean. That's the differentiation.
Exactly.
So if we had a bond that is issued in physical form, put in a piece of paper, which was quite common 100 years ago,
yes.
not so common now.
Yes.
But still, if we had a fund investing in these types of assets, this is something that we need to keep in custody, in a physical custody on our own. If we're talking about commodities like gold are not financial instruments.
Exactly.
So if we keep gold for the fund in our vault, then that's not strictly speaking a financial instrument. That's a commodity.
Yeah, exactly.
And there's the commodities and also all other assets. That's what they're called, other assets, because if they're not held in custody, everything else is other. Are subject not to custody duties, but rather to ownership verification and record keeping duties.
Okay.
So, for example, we could have a fund that's investing in real estate that doesn't have a single asset that needs to be kept in custody, because all they have is real estate.
Yes, that's it.
So for real estate, for example, what we need to do is make sure, it's exactly in line with what Alan was saying, we need to make sure that the fund actually owns this.
Exactly.
And of course, this with real estate, with private equity, venture capital funds, may become very difficult because the fund may invest everywhere in the world.
Yes.
They might have a very wide investment strategy, and you might need to rely on not only on what the fund manager tells you, you should rely also on external evidence that is available, so land registers, then certified translations come into play. It's really more than a role of an auditor/lawyer.
Yes.
Not really of a custodian, but because what you're getting there into is we want to make sure that the fund is actually holding this asset.
Yes, you go into a lot more than we think.
Absolutely, and so this is a very unique role, I would say, and I think a lot of custodians that were there on the market sort of before AFMD were not well equipped to deal with these types of duties because, again, this is a different profile, different profile role. You need people that know audit, you need people that know accounting, you need people that need local laws, depending on when the fund is investing. So, of course, this is, again, and as I'm saying, this other assets is a very unique animal because especially with considering that, for example, a notified AIF doesn't have any investment restrictions. It can invest in anything, anywhere. And with new assets coming into play, new asset classes like the digital assets becoming a new asset class in some funds, that's always a challenge.
Yes.
I would say I think the most unique, we had a couple of unique situations in the funds that we service throughout the 3 jurisdictions. I think one that was very interesting, unfortunately, a fund didn't launch, was a fund investing in classic cars.
Oh, wow.
So the fund was actually investing in specific vintages of Ferraris and Lamborghinis. And there was a group of volunteers at our team that wanted to go on site and actually do ownership verification and to make sure that the funds own these cars.
For the job.
Yeah, unfortunately, the sponsor wasn't able to raise enough capital. But these are the types of assets that you might need to deal with. And of course, in a firm like us, we're very excited to facilitate investment in these innovative strategies. Because this is always an interesting challenge for us.
Of course, at least a bit of change as well.
Absolutely.
In what you're
I
dealing
remember working
with.
once on a fund that used to invest in art. So we used to actually go and verify to the warehouse, like the store, and actually see that the paintings are.
Yeah, I mean,
that's it. More from a valuation point of view, that's very tricky.
But you need to ensure that they exist as well.
Yes, of course.
But that's really then relying on specialized
Yes.
custodians for these types of
Exactly.
assets.
Yeah.
So of course, if a fund buys a piece of art, they don't really usually keep it in the fund manager's
No,
office.
that's
You know,
it.
they employ a specialized service provider that
You would
has the
hope,
proper
yes.
security and proper conditions for
Yes.
keeping this form of art, and they also certify that this is actually the ownership of the fund.
Okay.
Another very exotic scenario, I would say, we had a fund in Luxembourg that was investing in physical uranium. So this client had a very good name, very good track record, and they were going around Luxembourg trying to find a depository that would be able to service them, and everybody looked at that and said, "No, this is crazy. I mean, how are we supposed to do that?" But in actuality, it was not that complicated because the physical uranium, again, obviously not kept at the fund's office.
Of course.
It was kept at specialized facilities in Canada and the US, you know, certified by NASA and all those
Exactly.
bells and
Wow.
whistles. So really, from a depository's perspective, after the initial due diligence of the facilities of the local framework, considering storing this physical uranium and evidencing ownership to it, you usually get just a piece of
Yes.
paper with all the right signatures of people running this facility,
Exactly.
certifying that in their facility, Fund X holds X amount of uranium.
That's it. Confirming.
It was good that our operations team was worried that they would need to wear hazmat suits and actually go inside the facility to check if the uranium is there. but luckily, we managed to avoid
Yes,
that.
that's good. Really interesting. So thank you for that, Philip. So we clarified a bit what we mean by safekeeping of assets and the different ways that these are held and protected. Building on that, Alan, we talk as well about counterparty risk. How do auditors address counterparty risk in our audits?
So before going into what counterparty risk is, let's understand what a counterparty is first. So basically, a counterparty is any party that may cause financial loss, loss of either financial or access to the fund in this case.
Yes.
Now, a custodian would definitely be considered to be a counterparty, mainly for two reasons. One, you're depositing cash with it. So over there, it's giving rise to, you have a direct credit risk exposure. Basically, you're depositing cash, and should the custodian go into default, or it may cause, you may not recover the funds, or your funds may even be frozen, which again, you cannot withdraw the funds. And secondly, the safekeeping of securities depends sort of on the custodian's performance. So here the fund is placing a lot of reliance on the custodian, that their controls sort of are operating effectively, and that they can place reliance on the custodian to make sure that they're doing their job properly, basically. Because otherwise, if they don't, it may again result in loss of access to your investments, potential litigation, and even financial loss. So over there, following those two sort of conditions, you can really understand that a custodian is a counterparty. Now, how do we address this risk from an audit point of view? I mean, as I mentioned before, and probably I'm going to sound like a bit of a broken record, but the main piece of documentation that we're obtaining is ultimately the year-end custodian report, and what we're doing here is basically verifying two main areas in the financial statements, which are our financial assets and your cash. Now, the most important thing is when obtaining this report, as we said before, is getting it independently, so directly from the custodian. And secondly, we would then need to verify who the beneficial owner is on the report. So it's not a matter of just getting the report, but we need to ensure that it is in the name of the fund, the client that we are auditing. Now, obviously, in the case of cash as well, we need to keep in mind IFRS 9 expected credit losses. So over here, speaking a bit from an accounting background, any financial instrument basically is subject to expected credit losses. It's a forward-looking assessment. But over here, we need to understand the reputation of the custodian, if it's credit rated, if it has a positive or a negative credit rating. Because obviously, if it's more on the negative point of view, it poses more risk, and over there, your provision for expected credit losses could be material and would need to be reflected within the financial statements of the company. On the other hand, if it's of a good repute and it's good credit rating, then over there you can pretty much conclude that the expected credit losses are deemed to be material.
Exactly.
But that's pretty much it. I mean, the custodian report is a key piece of information. Again, it's important that it's obtained directly from the custodian rather than from management of the fund to ensure that you're getting sort of that third-party documentation being obtained from a from an independent party. But that's pretty
Okay.
much it, and that is how it's sort of being addressed.
Yes. So in fact, Philip, if I'm going to turn to you, Alan went into as well credit risk quite a bit over there when talking about counterparty risk. So if we were to sort of dig a bit deeper into this, if I'm holding assets through a custodian, am I mitigating credit risk or can it be creating new risks in that case when it comes
I would
to
say both.
both?
Well, you're substituting one risk for another. I mean, but you need to bear in mind what the depository is actually there for. So the initial idea behind having a depository or a custodian within a fund structure was to segregate those assets from the
Exactly.
fund or the fund manager, to insulate the fund from that particular risk.
Yes.
So you're taking away that risk, but as Alan rightly said, you're employing a counterparty,
Exactly.
a specialized service provider, licensed, authorized, supervised by a local regulator, but a counterparty nonetheless.
Yeah.
So you're substituting a risk of actually losing the assets, the fund manager becoming insolvent, or your custodian being insolvent. You're a custodian in a sense of an entity that's just basically keeping the assets, not a pure depository. But you're substituting that with a risk that I would say is much more manageable, because the idea is that the depository you employ is a specialized service provider.
Exactly,
It
yeah.
has all the right controls in place. It fulfills all the requirements of the regulations
That's it.
and
the fact that
laws,
it's regulated,
making
obviously.
sure that it segregates the assets of the fund from their own assets.
Exactly.
And if they're using
That's a very
self-custodians-
important point.
Absolutely.
I mean, even
Yes.
from an audit point of view, you need to
Yes.
ensure that both when looking at the audit bit possibly of a custodian and even of the fund, the segregation of the assets,
Yeah.
the
That's the-
client's
that's the
assets.
Yeah,
crucial
the
role.
key. It's key.
That's the crucial aspect, and I would say that we work a lot with sub-custodians because our clients like to invest in different places, and they have particular service providers that they like to work with. So we're very much open to working with
Yeah.
sub-custodians that are of our clients' choosing.
Yes.
That means the whole setup becomes a bit more complicated
Of
because it's
course.
not just us. Is then we delegate our custody duties to a third party.
That's it.
Now, so we need to do proper due diligence in the beginning, and we need to constantly monitor that the fact that the assets are segregated, properly monitored, properly recorded. That
course.
happens throughout the whole custody chain,
Of course.
which can be quite a lengthy custody
Yes,
chain,
yes, quite
especially
quite
with
a
investments in more
process.
exotic jurisdictions.
Yes,
yeah.
and even from an audit point of view,
I mean,
it would impact
definitely,
our procedures.
As Philip said, a sub-custodian is appointed, then over there it's obviously going to increase our exposure and ultimately increase our risk. So we need to ensure that through our audit procedures and through our understanding, we are countering that risk to mitigate it and be able to carry out the audit in the
Yes, that's
best way
right.
possible. So to.
So thank you both for that. So we went through the roles and responsibilities of a custodian and a number of audit considerations. And now I'm going to turn to the annual reporting requirements, Alan, when it comes to auditing of funds. So certain funds are required to submit a custodian report with the MFSA. Can you tell us a bit more about that?
Yes, basically out of the MFSA rulebook, specific funds such as UCITS, AIFs and PIFs targeting experienced investors are obliged to submit a custodian report within the annual report, the financial statements of the company within the stipulated deadline as per the MFSA documentation timetable. Now, more recently, we had the NAIFs and the notified PIFs, which were introduced as well to the legislation. In terms of a NAIF, the NAIF is required and obliged to appoint a custodian. However, they do not need to submit a custodian report. Okay, so over there you can see as well a bit of a difference between your AIF and your NAIF. Whereas for the AIFs you are required to submit, where for the NAIFs you're not. On the other hand, for the PIFs targeting extraordinary investors and qualifying investors, and even the notified PIFs, appointing a custodian is not compulsory, it's not a requirement, so obviously you are not required to submit a custodian report. Now, what does the custodian report say? Basically, it's confirming two things, and there are two things that Philip has already mentioned in his first comments, where basically they're confirming that the fund is being managed in accordance with the investment and borrowing restrictions that come out of the offering documentation, and also that the fund is sort of being managed within the standard license conditions, and again the offering documentation of the fund. So over there you can see that compliance is critical, because you have the custodian who's confirming it from this aspect, and then you also have the compliance officer
Yes.
at the end of the day, who is also sort of ensuring that the fund is compliant with the standard license conditions and the offering documentation. So it's sort of, but it emphasizes the importance of compliance. Now, from an audit point of view, what do we do with this custodian report? Obviously, we're reviewing it and
Because they do become part of the financial statements.
yes, but it's part of the other information. Where over there we are not really giving an opinion on it. In fact, we actually say that we're not giving an opinion on it. However, we still need to ensure that what is being included in the custodian report is consistent with what is being documented within the financial statement.
What is disclosed within.
And even with what we've come across during our audit testing. Because if we've seen, for example, there was a breach to the investment limits.
Yes, and that is not obviously disclosed.
And it's not being reflected
And the custodian report is saying everything is great.
Then over there, you know, have a bit of a so
you may have doubts if the depository is doing their role properly.
So
might start again on the components and back to basics.
But that's like we're ensuring that obviously what's being reported in the custodian is consistent to what we've seen across the audit.
Filip, I'm going to turn to you. AIFMD2 stops short of introducing a full depository passport, but it does introduce what is often referred to as a depository visa, which is a very limited derogation from the general rule that the depository must be established in the fund's home member state. Could you explain a bit why what this change actually means in practice, perhaps going into as well a bit of exemptions and the conditions that are attached to this?
Sure, yeah. So actually the AFMD2 in its initial wording had something akin to a depository passport. Due to heavy lobbying from larger fund domiciles and the depositories there, this was actually substituted by what we call the depository visa. So the passport allows you to go anywhere you want, and the visa you need to apply on a case-by-case basis, and that's exactly how it works. First of all, there's a general condition at the jurisdiction level, so it only applies to jurisdictions with overall assets that are held with depositories lower than 50 billion euros. Malta is meeting that requirement. Obviously, Luxembourg, Ireland are not, but it is an option for the member states. So we know that some member states have decided against it. They prefer to have their own local depositories, and some are very willing to have it adopted to allow more competition on the depository market. Now, the second condition is actually a bit more problematic because it means that it's not automatic on a case-by-case basis. If you want to appoint as the fund promoter a depository that's not located in the home state of the fund, you need to provide the local regulator, so MFSA in Maltese case, with a reasoned request telling them that you are unable to find a depository. There's a lack of depository services. And what's crucial is the words having regard to the investment strategy of the fund.
Okay.
So it's not that we spoke at a lot of depositories, but none of them are really good for us. We would like somebody else. You have to say, I had to try to find a depository, but there's nobody there in Malta, in any other country, that services these types of asset strategies.
Okay.
So I would guess probably it might happen in some countries with digital assets. You want to invest in digital assets, you want to set up a crypto fund, but no depository in your home state is willing to take that on. Exactly. So then that would be a reasoned request.
Yes.
But it's really up to the local regulator how they interpret that. Some might give the fund promoters a bit more leeway, but considering that in each case the local regulator approves this reasoned request, they need to notify it to ESMA. Then they might be quite careful on what they approve and what they don't approve.
And it needs to be consistent.
So, we did some internal analysis and we believe that this will not have significant impact because if you look at it from a practical perspective, if you're a depository operating somewhere in the EU and you're being asked to provide depository services to a fund located in a different member state than you are based in, with local specifics, with local regulations that you don't know,
you need to know them.
You might be very careful before you accept that request. We want to be here as Q Securities. We're here since 2022, and we'd like to develop the market together with all the other depositories and fund market players.
Yes.
So we have taken that step. But if we were asked by a Maltese fund to be a depository while based in Poland, well, first of all, we would need to do a real proper due diligence and deep dive onto what it actually means.
Yes.
So I'm worried that in most cases, I'm sure this will happen, that in some cases we will have a depository from a different EU country.
Yes.
But in most cases, I think the funds will need to rely on their local resources when it goes to depository services.
Yes, agreed. And how would you see these developments impacting the role and responsibilities of depositories, particularly in terms of cross-border servicing and supervisory oversight? And I'm just going to add a bit more. While the legislation may allow for some flexibility, how important would you say that local presence still is for depositories, especially when it comes to understanding jurisdiction-specific rules and building those strong relationships with fund managers and other service providers?
Absolutely. So, as I said, the depository visa indicated in AFMD2 will, in my opinion, have little impact on the overall market. What is very interesting is that in December 2025, the European Commission published something called the Market Integration Package, where they propose in their goal to harmonize the EU-wide investment fund market a full depository passport. So no conditions, no assets under custody, no reasoned request. If you want, you can appoint a depository wherever you like in the EU.
Okay.
I'm not sure if that's going to pass, because again, I am expecting heavy lobbying from the largest fund domiciles. But if that were going to pass, there are a couple of challenges. So the first challenge is as I said, from the service provider's perspective, if I'm asked to provide depository services to a fund in Bulgaria, for example, I need to do proper due diligence that I understand what are the local specifics. Even though we have all these European regulation and ESMA with their Q&As and guidance, it's still not fully harmonized. There's still a lot of local flavor that you need to take under consideration to make sure that you properly fulfill your duty as a depository, which, as we said, is super important. On the other hand, there's the challenge from the supervisors. So if you're a supervisor in Malta and your depository that's operating here on the island is servicing a fund in Bulgaria, again, nothing against that country, by the way, it's a beautiful country, but let's say your depository you supervise is providing depository services to a fund in Bulgaria, how are you supposed, as a supervisor, properly ensure that they're doing it in line with the regulations? Which regulations you should apply? Your local ones or the Bulgarian ones, the local ones there? So it is a challenge, but I think considering that AFMD1 introduced the AFM passport, the management passport, and that's being commonly used throughout the EU, and you have Maltese fund managers managing Luxembourg funds, Luxembourg fund managers managing Irish funds, and the other way around. And it works somehow. And basically it ensured a lot of cooperation between the supervisors and with an overall umbrella of ESMA. I think this is possible. This is possible,
it can get there.
It can be done in a safe way. It can be done in a way that ensures the overall goal of the depository, which is protecting the fund investors' interests. I would say that even in that case, if we have a full depository passport, and you can appoint a depository from anywhere you want in the EU, local presence will very much matter. First of all, local presence allows you to understand fully and be up to speed with all the local developments. So, of course, you have the overall fund legislation, but then you have specific laws that in specific structures, like AFMD doesn't regulate regulates the activity of service providers, not the funds. So you have a UCITS that's throughout Europe, but you don't have a EU AIF that's the same structure. You have notified AIFs in Malta, you have reserved AIFs in Luxembourg, you have qualified investor AIFs in Ireland. Everywhere is a bit different and they're not the same animal. So you need to be there on the ground, you need to have boots on the ground to make sure that you understand what it actually means to be a depository for a notified AIF or a Luxembourg RAIF. You need to be there. Definitely. But the last point, I think that's even the more important part. It's that in the end, this is a people's business. Still, relationships with fund service providers, with the fund promoters, with the fund managers, with the regulator, that they all matter.
Of course, they go
and if you're not there, if you're sitting in an office that's 1,000 kilometers away from the office of the fund, it's obviously much more difficult to build those relationships.
Agreed.
And these relationships are sort of the fundament. I'm going to sort of piggyback on the name of the podcast a bit, but it's a fundament of all these parties working in cooperation in tandem to make sure that the fund's investments are safe.
Agreed.
And even from an audit point of view, I mean, as you mentioned, Filip, obviously having local presence in Malta for me as an auditor would give me more comfort.
Of course.
Yep.
They definitely know the local legislation better than someone located elsewhere.
Exactly.
So it definitely adds, and we can possibly place more reliance maybe, and it will definitely help and smoothen out the audit process. And as you're saying as well, the relationships, it's easier to contact. Okay, nowadays with online calls and whatever, you manage to get hold of them.
But not the same.
It's not the same. You can actually meet face to face and have those discussions face to face, it's
Of course.
for me gives a
That
different
matters, yeah.
feeling.
Yes, definitely. So I think that brings our podcast to a close. A big thank you to you both for joining us
pleasure.
here today and
Thank
sharing
you.
your insights on the topic. Thank you to our viewers for listening in. We will be hosting a third episode in the coming week, so stay tuned for that. And we hope to see you all soon. Thank you.
Thank you.
Thank you.